Hi guys, this is Abby from Forex Excel. Today I'll be discussing on how to refine your order block. So let's get started. So in refining an order block, one way to see it is in the lower time frame. So find OB is you will see it in the lower time frame. Okay. So the number one rule for me to identify an order block is to know your bias. So is your bias? Is it a buy or a sell? Or is it a bullish or bearish? So in this example, this is a bullish structure, right? So how can we refine our entries in, to have a sniper trades? Because it is very important that we minimize our risk, because when we try to refine our order blocks, that means that the stop losses are very minimum. So since this is a bullish trend, I'd like to see a demand. So when you try to see a demand, it is a, for example, this one, it is a area where there's a significant move to the upside. So this area here have this move because this mini structure here, let me just erase this mini structure here has been broken. So like, for example, this is in a bearish like move and then changed its character to the upside, and it means that it when it changes and have a significant move to the upside, it creates a demand, right? So it is, when we check, this is a 32 pips. So if this is okay with you, then it's fine. I mean, you can trade a 32 pip stop loss in your trading, but it can be improved when you try to refine your entries. So let me see. So as I've said earlier, you can refine it on a lower time frame. So let's go down to 15-minute time frame. Okay. So as you can see here, there's a lot of manipulation that was happened. And when you see this bearish move right here, it actually taken all the stop loss that are below on this trend line. So after after this manipulation, it took to the upside, right? You can see it on the 15-minute time frame. So this is this is a significant move because it has break this high, and you know it creates actually a liquidity right here. Actually, it breaks this week right here, but it is a significant because there's a lot of imbalance that has left after that break to the upside. So this is a good indication that you can refine your entry right there. So that's in 15 minutes, right? So we can try to go down to 5-minute time frame and see if we can refine it as well. So in 5-minute time frame, as we've seen here, there's a mini structure right here, or this one has broken. You may see a small candle right here, this one, that has been created because um you may see that this candle right here is already mitigated. So when it so I'll try to go to 3-minute time frame just to see how it looks when when it tries to push to the upside. So okay. So 1 minute time frame. So you can try this, but this is risky a risky way of refining your trades. But you can always put a minimum time frame, like you'd like to see refined OB in 3 minutes or 5 minutes. That's fine. So on this area, this one is didn't see any order block here, but I did it. I can see some, this one, like this one. So it has respected this last down candle that caused this break, this one. So it has this manipulation right here. Think you can see the range on the lower time frame or on the 1 minute time frame, and then goes to the upside. So it builds this demand zone right here, or this is the last down candle that caused this break. So you can use this as your refined OB. So right here. So it has respected, right? So the price goes there and push to the upside. So it is always good to test this in, when you try to back test or front test, and mark all those refined, because from 32 pips it will become like 8 pips or 7 pips. So hi guys, this is Abby from Forex Excel. Today you will learn on how to identify liquidity and the different types of liquidity. So let's start. So what is liquidity? So the markets need to generate liquidity in order to move up or down. So if the liquidity isn't already there, then it will be created. So basically, the basics are like support and resistance, double top, like this one, like that. Price have this one, double top, because the price have this structure like that one, or double bottom, this one, because they believe that if the price go in this zone, and the price will go up, or a trend line like this one. Then they drew a line of a trend line like that one, and vice versa if it's in the downtrend. So so these areas, as you can see here, like in this double top here, these areas has a lot of um sellers here. Sellers here. So their stop loss are here. So the liquidity is formed um above these prices, as well as on the other types of liquidity like this one, trend line. Liquidity is formed below in this trend line or above this trend line. So let me show you a sample chart. So in this one, so as you can see here, price have this uptrend structure, right? So usually the retail traders draw a trend line like this one. So if the price, for example, we don't know it this yet, like to we'd like to see. So for example, if the price go here, So you will like put your buy trade in this one, and then take profit here. So you expect that the price will respect this area and then go up, because this um this trend line is your what you call this trend line is your um indication that the price will respect this trend line and then go up, right? But in the liquidity side, um the financial institution and the banks seeing a lot of um buyers or stop loss here below here. So as you can see, the movement of the price drops all the way here and catch up all the um buyers or the stop losses below this trend line. So another example is, as you can see here, another example is this one, double top, right? So when you see um, a market behaving like this one, many of the retailers um suspect that if the price go here, it will be go down. Yes, it's true, but remember that there's a liquidity here. Price will go up there and sweep all the liquidity above it and then go down, as you can see here in in the chart. So yes, it somehow manipulates the market. Um, it will make you believe that if the price go here, price will go down. Yes, correct. But eventually, price will move towards on that zone, towards on this area, and will get all the stop loss here. As you can see here, it respects this zone, this one, and then goes down. So that's where we call this equal highs. So when we say there's an equal high, um we assume that the price will go up there and sweep all the liquidity above it and then go down. So another example is when we see a double bottom like this one. So when we see a double bottom like this one, we assume that retail traders assume that um you go if you see the price here, it will go up. Yes, indeed it will go up. But as you can see, there's a liquidity below on this area. Um there's a lot of stop loss here because they somehow bought here, and then yes, you can say that it is effective, but you always see how the market behaves on this kind of structure, because it will take it like what it has done on this one. So you have a double bottom here, goes up, yes, but as you can see as well, price went down and then go up again. So as long as we see this kind of structure, we can see how the price moves or reacts on those areas. So when we see a market like in this one, um like in an equal low, or retail are saying that it is a double bottom. So people thought that they will buy on this area, and so it generates liquidity below on this area. So we know that this area gets manipulated every time. So that's it, guys. I hope that you learned something new today, and we'll see you on the next lesson. Bye.